is be amongst friends again. And without much further ado, I'm going to proceed with some random thoughts. If I go too fast, stop me. I know time is short and I have a tendency to rattle off too quickly. If there's something you don't understand, then stop me then. And we will also have time for questions at the end. Okay, well, this is the structured presentation. Something about us human beings, because we are the players in financial markets. Then something about financial markets, which are part of the financial system. And then building up to the financial system itself. And then seeing how it affects Norway and the pension fund and the things you discussed yesterday and how we can move forward. Well, we are very imperfect beings. If you just have to look at the United States, you hear about all the rags to riches stories. You hear about Bill Gates and fortune made. But of course, I think 40% of the Americans believe that within their lifetime, they will belong to the top 1% of richest Americans, which is statistically impossible, but they believe it. And they believe it because the media talks about Bill Gates. They don't talk about the 100,000 other people who tried but failed. And that survivorship bias is something we all carry within us very strongly. There's an attribution bias, which is when things are going our way, we're like, hey, okay, that's my skill. This is because of me. And when things go wrong, it's because the world has conspired against us or some other random event has happened. Trending bias. We try and take a very short-term view of the history, of the recent history. You know, if the past 3 or 4 days have been good, we kind of expect all the rest to be equally good. And we don't look at a broader context of, the 30 years of my life, but instead, hey, and this applies very strongly, especially strongly in financial markets. If things have been profitable the past 3-4 months, you expect them to continue being profitable till the end of time. There's a black swan problem, and this is interesting. There's a philosophical treatise, I think Hume was the first guy to talk about it, who said that no matter how many white swans you see, you can never make the statement, all swans are white. But it just takes one black swan to say, all swans are not white. And this is the fundamental problem of human psychology as well as financial markets, that there's an asymmetry. There's an asymmetry between positive outcomes or when things are going well and one big negative thing which can take everything away. One great example is banks in the United States in 1982 lost all the money that they had made cumulatively for the whole century in 1 year itself. So if you were at any time in history, 1960s, 1970s, you saw, banks have been making profit the past 10 years, they've been making profit the past 20 years, so they'll continue making profit. But come 1982, and not just the profit of the past 5 years, but the profit of the past 100 years, all get wiped away by the Latin American debt crisis. And what we are seeing now is, the past 5-6 years, banks amazingly profitable. 2006, banks made $760 billion of profit. And now we're in the midst of another financial crisis. Who knows what losses they're going to make. So basically, the problem is human beings, and especially human beings who run financial markets, are extremely short-sighted and not rational. Unlike what you hear about in financial theory. There's a great example of Russian roulette, some eccentric millionaire who says, okay, I have one bullet in the 6 chambers of the revolver, and let me shoot you once. And if you survive, I'll give you $10 million. And let's say some desperate guy takes the chance, and he says, okay. And this guy clicks, and the gun doesn't go off. And this guy gets $10 million. And everybody will start saying what a smart thing it was for him to do. But of course, it probably wasn't. I wouldn't do it. Another interesting example is, if I ask you all to pick a number between 0 and 100, but pick it in such a way that your number will be half of what everybody else's average number will be. So if I just ask you to pick a number between 0 and 100, it will probably be average will be 50, right? Because somebody will say 83, somebody will say 17, something. But if I then ask you to think half of what everybody else is thinking, so you think 25, But then everybody else is also thinking the same thing, so they'll also think 25. So then the logical thing for you to think is half of 25, which is 12 and a half. But then everybody else is also thinking the same thing. So the logical thing for you to do is think 6.75, etc., etc. This is how financial markets work. What other people think is what you're trying to get rather than what actually it should be. There's another interesting case of there was a big thing. I mean, religion gets mixed into this sometimes. There was a woman called Evelyn Adams, and she won the New Jersey Grand Jackpot 2 times in 5 years or something like that. And there was all sorts of probability calculations that this had a 1 in 17 trillion chance of happening, that God had blessed her when she became a born-again Christian, or God knows what else. And what people hadn't seen was, what is the probability of anyone, anywhere, getting a similar sort of a jackpot? And that's actually only 1 in 30, which is not that unlikely. So again, another example of how, maybe I'm overdoing this, I'll try and stop quickly. But book jackets, another interesting thing. Have you ever seen a review on a book jacket that is negative? No, I haven't. And that's the sort of information that one derives from financial markets in many ways. You have this great fund manager who comes to you, look, I have been making profits for 10 years. And you're like, okay, maybe I'm going to put my pension money here. This guy looks good. And you put your money there. But of course, the only person who would come to you is the one who's been making profits. The person who made losses for the past 10 years is probably out of business. And the person who made losses for the past 3 or 4 years is kind of not going to be, he's probably changing jobs or something else. So there is a massive bias in the information you get from the financial system, which is a problem. I'll come to the other things. So this is a table of confusion. People often mistake luck for skill. What is luck, they think is skill. What is randomness, they think is determinism. What is probable or likely, they think is certain. What is a coincidence, they think is cause, and so on and so forth. So the lucky idiot becomes a skilled investor. Let's start with a group of 1,000 people, okay? Let's say markets are completely random. Half the year, half the time they'll go up, half the time they'll go down. So actually this is the basis of a scam, a Nigerian scam. I think it's actually works, yes. So here's how it works. I take 1,000 addresses from a telephone directory and I send people letters that next month the stock market will go up. I send that to 500 people, and to 500 people I say next month the stock market will go down. And of course it's going to go either up or down. So if it goes up, then the people who I send the first letter to saying that the market would go up, I send them another half of them, 250, saying it's going to go up, and 250 saying it's going to go down. And for 250 of them, they'll be like, hey, this guy said market's going to go up, and it went up, and next month it said it's going to go down, and it went down. And the third month, it will be, 125 who will be that way, and 64, and so on and so forth. So at the end of 5 months, there will be at least 32 people out of the random 1,000 I picked who will see that for 5 months in a row, this genius investor has made great predictions. Here's where I'm going to put my money. And that's where the Nigerian disappears. Anyway, but you're starting to see the point, I think. And this is the white swan and the black swan. This is interesting. In all my experience, I have never been in an accident of any sort worth speaking about. I have seen just one vessel in distress in all my years at sea. I have never seen a wreck, and have never been wrecked, nor have I ever been threatened in any way, predicament, to end disaster of any sorts, kind of thing. The gentleman is E.J. Smith. Does anyone know who E.J. Smith is? He was the unfortunate captain of the Titanic, talking about how he had never been in any accident, how everything was great. And that also brings us to the life and times of a Christmas turkey. So you have a turkey, it's born in an organic farm, it's free roaming, it's ranging around, it's thinking every day, hey, my life is good, I've been alive, and come close to 20th of December, and the turkey's life, which has been, so if you were thinking, what is the likelihood that the turkey is going to be alive tomorrow? So every year, every day, it's good, and suddenly, the turkey's killed. But this is the sort of stuff that happens in financial markets. And this is what happened to the Titanic. Big, unexpected, negative events which undermine all the recent history of positive events. This is another interesting way we can look at some biases. So, let's say you have a bad investment, and it gives a minus 10% return on average, and there's a 15% volatility. So it's kind of volatile because it's not certain, but it's on average it's minus 10. So in a year, there will be a 93% probability that you will lose money. But the way statistics work is when you start reducing the duration of that, in one quarter there's actually only a 77% likelihood that you will lose money. And when you bring it down to an even more micro level, in 1 second, there is almost an equal likelihood whether you're making money or losing money. So what it means is that even if your overall bet is really bad, in any given period, things can actually look good. And on the basis of that, you project, hey, things are going to stay good. But in the overall shape of things, things are going to be bad. And an interesting example is we tend to ignore outliers. I don't know how many of you studied economics, but if you did, what you normally do is you take some data sets, you do some analysis, and you take away the extreme values, and you say, oh, well, this is how things look. This is what people did, and this is what led to global warming being discovered so late. The temperature rises that people were looking at the history of temperatures on the planet, and there were suddenly these big outlier values. So the average had been this, and there were these spikes. They were like, oh yeah, but that's not important. And that's not important, but that's actually global warming. So global warming took about 5 to 10 years more to discover or to scientifically pinpoint than it would have if people had not ignored those points. And the same with financial markets. There is an inherent instability in financial markets for all these reasons I gave, but also add to that. So what is a bank? In a bank, you put your money, and you can withdraw it any time for the most part. But the bank lends this money to corporates or, for a 5-year term or a 10-year term, etc. So the bank can't withdraw its money from its clients in the same way that we can withdraw it from the bank. And this is the sort of thing that if we think the bank is in some sort of trouble, we go line up and we bring our money out, but the bank can't do it, so the bank goes under. This is what happened to Northern Rock in the UK recently, and there's a whole history of bank runs, including in Scandinavia. So it's a confidence trick. The minute the confidence is shattered, the whole thing can collapse. Then there's another big problem with assets. What is a bond worth now? Or what is a share of IBM or Telenor worth now? It's based on our expectation of future profits for the next 10, 20, 30, 40 years. That's extremely uncertain. I just showed you how randomness actually defines most of what happens in the world, and it's just extremely difficult to pinpoint. And what it means is, again, the way that prices are calculated, if the interest rate changes by 0.5%, that can lead to a 10% change in the value of Telenor stock just overnight. And which is why we see these big spikes up and down in stock markets. If there's a 2% change in profit, that will mean that 2% drop in profit, it could actually justify saying that Telenor stock, instead of being $100, is worth $60. That's a big fall. So when you look at assets and financial assets and stocks and bonds and the way they are priced, even very small changes in expectations can actually lead to massive changes in prices. And so that's another degree of instability. In addition to that, what we do now is, it used to be that people bought stocks with their own money. But now I have $1 to invest, I borrow $9. That's leverage. And I use $10 to buy a stock. So what it means is, if the stock generates a return of 2%, now I will be getting a return of 30%. Because you only give let me go with this again, sorry. You can borrow at 5%, and the stock price goes up at 10%. So what you do is you borrow a lot of money, and you put it in the stock market, and the stock price goes up at 10%, and of that you give 5% what you borrowed, and the rest you keep the 5% margin, not just on your own money, but also on all the borrowed money. So your actual profitability increases by 5 to 10 times. But the same thing happens the other way, that even if you lose money on the stock market, you still have to repay the loan. And that means that your losses get amplified too. So leverage in the system, which is what everybody has been doing, including hedge funds, etc., it significantly increases. So normal financial markets look like this, but with leverage they look like this, even more unstable. And we talked about this guessing game of the number, and this is a famous concept of the Keynesian beauty contest, where it used to be that in newspapers in the 1930s, 40s in the UK, there was a contest. There was 10 photos of participants, of beautiful women, and people were asked to rank them. And there was a prize if you got your ranking right as with most other people. So what you had to guess was not which woman you thought was the most beautiful, but which woman other people thought was the most beautiful, and everybody else was doing the same thing again. So there's also this concept of greater fool, which is related, and which is what happened with the internet bubble. Worthless companies trading at massive amounts of multiples of zero earnings, and a company which actually has no assets trading for $100 million. But as long as you thought that there was someone who would buy it from you at $110 million, as long as you thought there was someone who was an even greater fool, it still made sense to buy. So that's what you did, and that's what you do. And assets are really strange. You know, if the price of coffee goes up, if cappuccino suddenly went up by 50% tomorrow in Oslo, I'm sure we'll start drinking less of it, right? Supply, demand, that's how economics works. But with assets, that's not how it works. If house prices start going up in the United Kingdom as they did, and once they reach a certain threshold, people become sure that, hey, you know, this is a sure bet. They're going to go up. They've been going up for the past 3 years, and even more people want to buy. And that means that the prices go up even more, and it all becomes self-justifying. And the same thing when things slow down. So unlike with normal goods like coffee, with assets, when prices go up, demand can go up. When prices go down, demand can go down. So there is no stabilizing impact. And there is this something called fallacy of marginal pricing. But what it basically means is you have the Oslo Bros, you know, the Oslo Stock Exchange, and let's say it's worth $100 billion. Now, let's say just $1 billion of additional money goes in, new investment. But it could easily mean that the prices go up much more, so that the total value of the Oslo Stock Exchange is $110 billion now. So even a small amount of money coming in can increase the prices quite significantly. So the people who own shares in the Oslo Stock Exchange will feel that they are $10 billion more wealthy now, when they're actually not. Only $1 billion of new money has come in. So that's a serious problem, and that's another part of the market imperfection. Sorry, am I going too fast, or?
Yeah.
Yes. Sorry for said that.
I was going to say, but I didn't.
Well, you should have stopped me. I asked you to stop me. Okay.
What did you say that last part?
Okay. Basically, you know that when you start buying a stock of Telenor or something, and you just put in your $10, but it drives the price up. But it drives the price up not just for you, but for everybody else. So what it can mean is that even a small amount of money being invested in a house or a stock, etc., can mean that the overall wealth effect, because the price will go up for everybody, so people feel much richer than they actually are. And of course, when people try and sell, then the price falls dramatically. So does that make more sense? Okay. Is
you call it air money?
Yes, exactly. It's air money. That's a good term. I'll use it. And so what you have is, you have all these inherent instability in the financial markets, plus you have all the biases that affect us, which we talked about. Plus, added to that is the increasing speed of the financial system and its complexity, and there's a lack of transparency, including through the use of tax havens and derivatives, and regulation has been going down and down rather than up. Put all of this together and you have an explosion in essence. And this is another example of how markets are not efficient. Everybody says that markets that assets are priced, on economic fundamentals. But of course, we, having just been through the presentation, we know that's not true. And this is an actual result of a survey of foreign exchange traders. They were asked what did they think was the most important factor affecting the price of a currency. And only about 30 to 40% said it was economic fundamentals, which theoretically 100% should be saying. There were people who said bandwagon effects, which is, if Martha is doing it, I'll do the same. Overreaction of news, speculation, technical trading, computer trading, etc., etc. This is another interesting thing. This is from when I used to be a derivatives trader, and I actually traded on this particular parameters. So you see something like this, and you say, this is probably going to go up. Right? I mean, that's what it looks like to me. And now I have told you we have a bias, so you may not think that, but this is the natural reaction. Hey, okay, yeah, this is going up. But what you have to see is that this is what the longer series looks like. So this thing, if you're just looking at, the data of the past 5 or 6 years, this is all you see. But in the long term, this is what you see, and you get a very different conclusion for what is going on. But unfortunately, people mostly just see this, and this is how they trade, and that drives instability. Sorry, it's stuck a little bit. Okay, it's stuck. Doesn't matter. Okay. This is another example. This is also from one of the trades I did. So this is what the data look like. And what you do is you try and look at what the data is, and you try and see, okay, what theoretical model does this fit? And that's how all of economics works. And with just very small change in assumptions, you come from this data is approximated by this distribution to this same data is approximated by this distribution. And one trader could make that decision and the other trader could make the other decision. But they look very different to me, and they are very different. But, so markets are not really rational. So what has happened is that in the financial system now, think it was a car, and the driver driving the car was very well trained and went to driving school and all of that. Road was smooth, and there were speed cameras to check, regulators looking at the car, checking everything was okay, and if something went wrong, there were police cars chasing that road. But accidents still happen, and there are fundamental problems with the financial system, so accidents still happen when the financial system was like that. But now it's fuel-laden big truck, one of those big Volvo trucks you see. There's no speed limits, and it's racing around on a track. The road is bad, full of potholes. And even when the speed cameras are there, when we, people like us, rational people, as an Attac, we see something is wrong, hey, house prices are going up too fast, there's a bubble. The regulators don't really do anything about it. So there are no police cars, there's no enforcement mechanism. And the cops are blindfolded. I mean, seriously, this is how things have become. So, existing regulation. Well, my question to that is what existing regulation? There has been breakdown of the gold standard, credit creation, capital accounts have been freed, and increasing lobbying power of financial institutions. If Nordea or Goldman Sachs says something, everybody sits up and takes notice. If Attac says something, people ignore us. There's an incentive misalignment. I don't know how many of you know this, but banks make most money when the financial markets are most unstable, when things are calm. banks don't make much profits. And there's a fundamental incentive problem with that. So it's in the incentive of banks to have things going up and down. And there's, of course, another incentive misalignment. I'm a trader, and when I make a profit of $10 million, I get $2 million of that as my bonus. When I make a loss of $10 million, I get fired, but then I just go to another firm and take another job. So the incentives for both institutions in the financial industry as well as individuals to take additional risks are very strong. And especially when they are not checked, especially when regulation is bad. What's that?
Yeah.
Okay. And especially when regulations are bad, this can lead to catastrophic consequences. In addition to that, we have come to an international system. Money flows freely across borders, but regulators are still very national. And that means they don't really know what's going on. There's been the big rise of offshore banking. Most of the financial flows in the world at some point go through tax havens, which are famous for their lack of transparency, which adds to the degree of opacity and that nobody really knows what's going on. There's universal banking. There are many institutions now. Think Nordea, think Citibank, think Deutsche Bank, which are just too big to fail, and they know it. Nordea knows if it takes some risk, if a trader blows up as one did in SocGen, somebody makes $5 billion in losses, that it is such an important part of the Scandinavian economy that the Scandinavian governments will come and use taxpayers' money and bail it out. And that again increases the incentive for taking risks and decreases the incentive for responsible behavior. There is the additional problem of derivatives, which add to the complexity and which further take away any transparency. So basically what has happened is the financial system, which was already inherently fragile, has become far more fragile because it's become far faster, regulation has gone down, transparency has gone down, and it has become more complex. So it is a disaster waiting to happen, and it keeps happening, and it affects our lives of people who don't actually really deliberately have a big stake in the financial system. And it also affects the lives of farmers in sub-Saharan Africa, and only a few people benefit, but the losses are spread around to taxpayers all around the world. So there is an increasing degree of financial crisis, increasing instability. We are seeing increasing inequality in the world. Finance, instead of flowing from where there is too much to where there is too little, flowing from Norway to sub-Saharan Africa, or Russia, or London to sub-Saharan Africa, is flowing uphill from sub-Saharan Africa to London to be invested in London real estate. Russian billionaires, instead of investing in Russia, are putting their money in Chelsea real estate because house prices are going up by 20% a year. If you invest in Russia, you earn 10% a year, which is a lot. But the financial system has become increasingly dissociated from the real economy, and where the real productive power is who's actually working on the ground, who's tilling the earth, who is making products in factories, etc. Their compensation and their role in the world economy looks like completely, if you draw a map of that map will look completely different from a map of who's got financial power or where financial flows are. So the two have become completely dissociated. There's an increasing buildup of risks in the system, and we are looking increasingly at a shorter and shorter term. Can you deliver profitability over the next 3 months? You've been profitable for the past 5 months, so hey, okay, you'll be profitable for the next 5. I'm going to give my money to you. Everybody is looking at ever shorter terms. And of course, the increasing speed, complexity, size, and power. This is just how money is flowing. This is South Africa. And this is money going into South Africa when the graph is positive. There's a little bit of aid. Debt, there is more money being repaid in old debt than is going in the form of new loans. Debt is a negative channel of flows. There is some migrant remittances going in, there's some foreign direct investment going in, there's some investment into portfolio equity, but South Africa has a big trade negative balance, so it imports more than it exports, it's losing money, it's building up reserves, and this is capital-like money that is flowing out from under the table. So the financial system and most of what we talked about was problems of money, which at least people, it's captured by statistics. We know where the money is going to, etc. But in addition to that is a massive additional element of money which flows out from under the table, which nobody talks about. So, for example, for the developing world, if you just looked at money that was captured by statistics, which was being drained out of poor countries and being sent to rich countries, that was $550 billion of money above the board that the developing country was putting in the developed world. Developing countries were putting in the developed world. But in addition to that is another 500 billion that is not captured by statistics, which flows out from under the table. That's not the focus of the presentation, so I'm going to skip it. Some characteristics of the financial system: big increase in size. There are $80 trillion of assets under management. Big increase in the speed and the turnover of financial markets. For example, the foreign exchange market is $450 trillion. I lose, the mind boggles when you get to numbers beyond, beyond 1,000 or 10,000. Trillion is too big to imagine. There's a massive increase in complexity, and there's a massive decrease in transparency. So I was talking about financial assets and real assets. Now, theory says that, what is a stock in IBM, or what is a stock in Swatch, which is the watch company? Well, it means that if I own 10% of Swatch, that means I own 10% of the factories and the skills of the workforce, etc. And these are things you can touch, things you can eat, for example, which is the product of a food company, and things you can sit on, which is what a chair company produces. So ideally, financial assets should be the same as the total stock of real assets, because it's just saying that, hey, I own that factory that is making that thing. And that's how it used to be, but since this financial liberalization, this is 1980, the total stock of financial assets in the world has gone to about, this is 2000, now it's about 4 times. So 4 times of the stock of real assets, which means that there is 4 times too much wealth, perceived wealth in the world than actually is there. And that also means that this bubble can burst any time. And what we are seeing, what we saw with the dot-com bubble, what we saw with the crash after the September 11th attack, and what we are seeing now are all mini bursts of bubbles, which bring this down a little bit, but it's still up there. There is there's a much further drop that we can potentially fall into, but hopefully won't. This is what I was saying. The average opinion expects average opinions to be, and successful investor tries to establish what everyone else in the market will believe everyone believes, and you get into smoke and mirrors. Well, this is Scandinavia, which has been quite successful in meeting the challenges of globalization. It's seen rapid economic growth and new technologies, etc., and good human development indicators. You've heard good things about you. Almost, or used to be, the highest tax rates in the world, and the success is because of high tax rates, not in spite of high tax rates. And it's the money which finances first-rate education, finances infrastructure, research, and a strong safety net. And this is important in the context of how and if the oil fund money should be used. We have a history of how we have been successful, and that history has depended on this good education, high public investment, infrastructure, research, and a strong safety net. And these things are being undermined because of the financial system and tax havens, etc., and Mayor Simpson. But the safety net is especially important given the changing structure of jobs in the economy, given how rapidly China and India are taking over. And there is a threat. I mean, it would be, some might think it's politically incorrect to say, well, China and India are stealing our jobs, etc. But the fact of the matter is, they are, and they will to an increasing degree. You will have more and more research, basic research being carried out in India. You'll have more and more, in the United States, there's an increasing degree of medical services which are done remotely from India. So eventually, slowly, things which started with low skill levels of call centers, etc., are going up, and the only way we can stay ahead is by going further up the skill ladder, and which is why research and education are extremely important. And the social safety nets allows us to move jobs without having the kind of insecurity in 50 million people without health insurance as in the United States. Don't have time for that. State of the nation. So this is the state of the nation. You've heard about the subprime crisis. I thought I'd say it. This was the situation 2006. 1/5 of the mortgages taken out of the United States were by the shakiest borrowers. Half of them were underwritten by completely unregulated firms. And the money being given was on average 95% of the face value of the house price. And then it was packed and sold away. So the firms which actually gave the loan did not keep it on their books. So they did not have an incentive to be careful, because if there were losses, then the losses wouldn't go to them. And this, how good these loans were, that was decided by credit rating agencies, which were actually paid by these guys. So they had an incentive to say the loans were good. And this was bought by banks in faraway lands like Germany and France and United Kingdom, etc., who put it off the balance sheet. So it doesn't show on the bank's annual statement, and they put very little capital, and regulators knew nothing about it. And, this is the perfect recipe for disaster, and we have the subprime crisis. Okay, so sovereign wealth funds, and what's the correlation with everything else? The thing with sovereign wealth funds, like the Norwegian pension fund, is that by necessity, this has to be invested in the world economy and through the financial markets for the most part. And here is where there is a problem, because we've just seen how tricky the financial markets are, how they have become much more risky, how things could blow up. And as in the case of banks, profits made over 100 years could be lost in 1 year. And it's true of the Norwegian pension fund, which is why we need to care, because our future, 100% of our GDP, a lot of money, a lot of sacrifices we have made by not using the money now, is now invested in the global financial system. And so it's in our interest as Norwegians, as Attac, to ensure that that financial system does not blow up. Because if it does, we're fucked, and we don't want to be. So, but it's not just us. Well, that's right. Not by the financial system. Let's put it that way. Sovereign wealth funds. So it's not just Norway which has the pension fund. There are 28 countries, and increasing number which are having similar funds. That's about $3 trillion now, of which 10% is Norway's money, 90% is nations like Kuwait, China, India, etc. But it's projected to increase massively to about 10 trillion just in the next 4 or 5 years. So more than treble. And that's because oil prices are high, and we are putting more money in our oil funds. Saudi Arabia, Kuwait are putting more money in theirs. In addition to that 3 trillion, there's about $6 trillion of foreign exchange reserves, which are held by banks in Brazil, central banks, etc. And that's to guard against the kind of crisis that happened in Southeast Asia in 97, 98.